going to be that big session where things are going to be coming at you pretty quickly. We're going to be talking about a lot of content today. I know we broached some of the subject of course, moving averages, support resistance, and such last week, but we're going to be diving more into indicators this week. It's a little bit of a primer before we kind of talk about the homework and such. There are there, or I should say, there were classically three different pillars of technical analysis: trend, momentum, and volume. And now there's actually a fourth pillar, called volatility. A lot of traders will look at, and we'll be diving into all four of those types of indicators today. Now, that said, building on this, we do have one-off classes where we actually spend an hour individually on trend indicators, an hour individually on momentum, et cetera, et cetera. I remember earlier on this week, I think it was Monday, I was partnering with Troy. We did a session on trend indicators. And so we'll take what we talk about as almost to a fire hose that we spent an hour on today. We'll break that into four separate hour-long classes. And we dive even deeper into some other classes on that. So please, please, please send in your questions. Send in your comments that you have to us. And James, we can absolutely use that particular security as an example. You start to pull up AccuTrader Pro and dig through some different securities. Now, that said, we have a bunch of content that we want to talk about, want to cover today. But before we actually jump into today's content, I want to give Peter the opportunity to kind of dig through and review last week's information with us, review it in the form of the homework that we have that we made available. Now, if you didn't do the homework, that's okay. Like we mentioned last week, we're not going to call your parents and tattle on you. This is it's for learning purpose only. We found that some people learn better through different ways, and this is something we've gotten feedback on that a lot of traders they appreciate because it helps things kind of stick a little bit more. That said, though, Peter, go ahead and take us away.
Yeah, will do. And I apologize. I was wrapping up a previous session that I had, so I didn't see that symbol. I think you said James popped in. Let me know that symbol or if there's another symbol that we can use. Point being, there's actually a little project that we won't spend a ton of time on, but do want to at least, as always, make it as much of a two-way street as possible. So whatever that symbol was, let me know, and I'll try to pop that in for our project here towards the bottom. All right. I did take the liberty on this homework, as I've been doing with lots of our homeworks. I went ahead and kind of gave us the answer key, so to speak. I highlighted the answers that we're looking for. That being said, I am still going to talk through them because I think that can also help out a tremendous amount. So starting things off, from week 2, we talked about a number of concepts. One of them was support and resistance, and that's what question number 1 gets into. When support is broken, it becomes, or can become, I like to say, what? Well, resistance. You see the answer here and now, that thought process of mentally kind of having a flip emotionally from some traders out there. They see a line in the sand where there's been support, all of a sudden it breaks that support. Well, that can kind of flip on us and become resistance and vice versa. So keep those concepts in mind, and we'll speak to some of that today as well. True or false? Support and resistance can only be drawn horizontally. And I say false to this. Support and resistance, I think classically, from a textbook definitional standpoint, are usually thought of as those horizontal price points or areas of importance that we like to call them. But I'm sure if you have been in some of our market briefings or some of our other sessions, you've heard me and others on the team talk about, is it finding support or is it being resisted at maybe something like a trend line, maybe something like a moving average that might actually have some type of upwards or downwards tilt or trajectory to it. So concept of support and resistance kind of goes back to, is it respecting said maybe indicator that you're looking at, trend line, or yes, can also include those horizontal zones as well. Which of the following simple moving averages will react the fastest? Talked a little bit about this last time. We'll talk about it more today as well as we kick things off, but the answer we're looking for is a 20-day moving average. And the reason being, simple moving average is going to be looking at those previous close prices and then taking the average of those price points that are found. So you can imagine 20 days worth of information or 20 periods being factored into a calculation can change very quickly given the percentage weighting each day has. In comparison, if you're day over day changing something like 100-day, well, this can be subject to change by about 1% or so. That's kind of the percent weighting that a 100-day has. 200-day is going to have that 0.5% weighting. 50-day, a 2% weighting. 20-day, a 5% weighting for each of those days, which is why the day out, the day in are going to then be making that type of curve or trajectory for that moving average react faster. Talked a little about breakouts, a great topic and conversation there. They can occur in which direction, up, down, or both, and up or down is what we're looking for. A breakout being defined as some type of price action. If kind of my mouse cursor is pinging in between these couple questions, these couple sentences, and then all of a sudden, boom, it breaks out higher. I think about that old video game from back in the day with that name itself, breakout, where you see that ball kind of pinging, 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 and then all of a sudden it kind of can break up and out. Same can be true kind of breaking down as well if your paddle doesn't move over in time. Those that know. Maybe I'm dating myself on old classic video games from back in the day. Question 5, which of the following are used as filters for breakouts? We've got price passes close, multiple days above close, and a percent above close. And all of the above is the answer we're looking for. It can even be more of these. The concept of a confirmation filter, a classic example I always give is that a confirmation filter or filter for a breakout is our signal. The confirmation filter is some gauge that we then have more confidence that our signal is for real. Example I give is if you are at a red light and the light turns green, do you smash on the gas and immediately just go right through that intersection? Or do you maybe wait 1 second, 2 seconds? Do you maybe look both ways, kind of checking to make sure no one's running their red light? The green light in my example is the signal, and examples of a confirmation filter would either be waiting a second or two, or maybe checking both ways before proceeding into that intersection. Which of the following are required with trend trading? Having an entry strategy, having an exit strategy, or some type of assessment of capital risk. And it's all of the above, position management, position sizing, knowing what is going to trigger us to go ahead and get into a trade strategy, and then also knowing when that trade thesis that capitulated our entry is then going to get perhaps invalidated and make us exit. Or maybe our trade thesis actually came to fruition. We have reaped the rewards of our risk. We're now looking to go ahead and capture that profit potential. Exit strategy doesn't always have to be a negative connotation. That can be when our trades worked out, which happens from time to time, at least for some of us. True or false, technical analysis attempts to predict the future. That is false. Technical analysis should be used as a tool to react to what is happening and then plan for the future. So that's what we would want to critique kind of on that there. All right, let's go ahead and get into the project. Really what we're looking to do is just get more comfortable with Active Trader Pro. I'll make quick work of this, trying to draw support and resistance lines, maybe actually adding in Recognia's view of things as well. Let me look over here at the Q&A, see if that symbol had come through for us. Brian, I apologize. I'll definitely try to speak up a little bit, or if I need to turn my microphone up. Nick, hopefully I'm coming through kind of loud and clear for you. And Brian, I promise I'll try to take a look at my settings once I pass the mic over to Nick, just to make sure nothing had changed. James was giving us LDOS, Leidos Holdings, I believe. Don't know this symbol offhand, but doesn't matter, right, folks? Whether we know a symbol or not, technical analysis is really all about being able to draw some lines regardless of what that symbol or watermark is there in the background. So back to the homework, support and resistance. I could maybe see some broken resistance. Here we kind of see a bit of a top or two, and then it really is able to go ahead and kind of, as I call it, get that escape velocity, break out of these previous points or line in the sand and actually move higher. That might then, as we had talked about in our homework, be broken resistance that might potentially turn into support. And really looking at a position that's higher right now, kind of resistance, at least at this point in time, might coincide with where this price action has gotten to, but maybe turned away. Pretty tight range, but maybe you want to call it about 148, 150, somewhere in that range where it has moved away from us. Now it says to use Recognia's support and resistance. That's under technical analysis. Support and resistance is what we can go ahead and click on here. Well, not too far off. Like I said, resistance may be up at about 148, 150. They're saying about 148 and change, and then maybe some support, which had been resistance, down at about 128. So, like we talk about, is it an art? Is it a science? It's a little bit of both. Was I too far off the beaten path? No, not really. Would some of you draw your line here? Potentially. Would some of you draw your line here? Potentially. That's why I like to personally use these rectangles, kind of a zone or area of importance rather than just a fine line right at 128.22. I'm not a computer, so I don't have an algorithm working in my brain. I just have to think about, okay, if I squint, where might those lines in the sand be? All right, now adjusting the settings on those time frames. Recognia will go ahead if we click on this modification. If we click on the support or resistance line, we have the ability to modify things. And really the thought process is this is support and resistance maybe from an intermediate term perspective. Okay, we can take a look at this at a long-term perspective as well. Maybe the support's actually far down below kind of what we had been working our way up through. Resistance didn't really change. And then on the flip side, if you are a shorter term investor, is that going to be much different than the intermediate? In this case scenario, no. It's not always going to be different, but sometimes it is. So matching our outlook and expectations, as well as maybe those tools that are supporting us with those outlooks, keep in mind that there is the ability to modify those as well. All right. Find a stock or ETF and identify a breakout as kind of is a one size fits all symbol that we've got here, Nick. I don't know about you, but I would classically call this zone a bit of a breakout like we're seeing here. Maybe a little bit of history repeating over on
Yeah,
this side as well. Had a kind of area or
little
zone
breakout
of
there. Yeah,
resistance that then begin to kind of catch velocity and get that breakout here towards the upside. And kind of think about it here as well. Going
thinking
back to
of
maybe example, it's more of a downward sloping trend line potentially,
read my
not
mind.
too far off the beaten path of a horizontal, but maybe if you're connecting the dots on these wicks, it's got a little bit of a downward sloping tilt to it. Not much, but maybe these successfully lower peaks, or maybe you want to draw your line over here. Once again, a bit of a art and a science, and then all of a sudden we've got this breakout putting in higher highs than we had seen, and obviously higher lows as well. All right, Nick, that's all out of me. I'm going to catch a drink of water. Like you said, jam-packed session here, a few minutes longer than I wanted to go on homework, but nonetheless, I think it's important, especially lots of technical analysis, right, is about feeling comfortable with the tools that we have. It can be a bit subjective, so we want to cover some of the foundational concepts, the what do we call them? Generally accepted, kind of principles. If you were to open a textbook about said indicator, yeah, have a understanding of its calculation, of course, and then we can get into a little bit about any modification that you might want to adjust for your own particular style of trading.
Absolutely, absolutely. Now, couple quick points I want to make. We had some questions that came in. Sastry actually asked what the definition of short term is, and I'm going to say it depends. I've worked with a couple of traders that anything held less than a year, they consider to be short term. I've worked with other traders that anything held overnight is long term, and so it's relative. With that, short term could be minutes for you, could be hours, it could be days. Short term could be 2 to 3 years, and longer term is 5 to 10 years or something like that. And so it's going to depend on the trader, but generally traders that will employ technical analysis tools might look at something that's swing trading or less. If you're trading a couple days to a couple weeks, that might be shorter term, where if you're investing, that's going to be longer term. We did get a question on earnings. Thomas, you threw in that question. If you could kind of clarify a little more for us on that. If you're talking about kind of that pop up in LDOS, that very likely could have been earnings. We'd have to pull back up that chart to take a look at that. And earnings is something that kind of dives into more the fundamental analysis side versus the technical. And you literally have kind of a different company post earnings versus pre earnings and such. Yes, and you confirmed it. That was LDOS that you were talking about with that. So that said, I want to kind of introduce, kind of ask the question, what is a technical indicator? And the big thing is it's mathematical calculation based on price and or volume. Goes back to what we've been talking about the last 2 weeks. Indicators are tools. It's a calculator and such. Something like a simple moving average is simply averaging up the last so many trading periods. It's mathematical calculation. It's a tool on that, which is different than those lines that Peter was drawing, where it's a little more art with that. Yes, you can program something to draw a line based on criteria, but comes to indicators. Indicators are, they are what they are, so to speak. We've already kind of set the stage a little bit on, some of the different types of indicators are out there. I mentioned trend, momentum, volume earlier. Also talked about volatility. Support and resistance indicators can also exist. And this kind of gets back into that calculator. That's, if you're utilizing something like Fibonacci's, drawing from the very bottom to the very top, being a little more clinical, well, what those levels are, they're going to be what those levels are. That's a little bit more science versus art with that, so to speak. That said, let's jump into trend indicators. And some of this is going to be a little bit repetitive. We've talked about some moving averages, in the past and such, utilizing them. Talked about how a moving average can act as a support or resistance with that, and how that they are non-horizontal support resistance levels. So first off, the way that a simple moving average works is you're simply adding up the last so many periods. And I keep mentioning periods because, like we talked about beforehand, if you're on an hourly chart, well, a 20 period simple moving average is going to add up the last 20 hours. If you're on a minute chart, it's going to be the last 20 minutes. If you're on a daily chart, it's the last 20 days. And so just because you've added a 20-day moving average on a daily chart, if you change your chart to look at just today, well, likely the default is now it's going to be a 20-minute moving average. That's going to change. It's not going to stay at 20 days, so to speak, with that. Now, there are some basics associated with this. And basically, if a moving average is sloping up, the trend is considered to be up. If a moving average is sloping down, the trend is going to be considered moving down. Now, I just mentioned trend, so to speak. I don't specify short-term, long-term, intermediate-term, etc. Well, that's where these different time frames come into play. Now, some very, very common time frames that are utilized are, of course, the 20, the 50, and the 200 period moving averages. A lot of traders looking at a daily chart are, of course, going to be looking at the 20-day, 50-day, and the 200-day moving average. That's kind of what this is addressing, what this is talking about. So, a couple kind of examples I want to show and want to talk about. And I'm going to pull up AccuTrader Pro real quick. I'm going to share my screen. We'll flip back over. I'm looking at the Russell 2000. And I utilize this exact same example talking about support resistance levels. talking about the zones, because we were talking about how there's resistance right there. Here was support, kept bounce, 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 and then bounced off these same areas. But if we're looking at this right here, we ask the question, well, what is trend? If we're even looking at it like this, well, what is trend? Well, we might be eyeballing this and saying, well, it starts in the top left, ends in the bottom right. Well, trend is down. But looking at the 50 period, the 20 period moving average right here, we see it was sloping up and now it's sloping down. Keep in mind, again, these are lagging indicators because we have to have past price data. And seeing this, how this was sloping up and then sloping down, and the 50 period is still sloping up during this entire process of this. And we can guess that before this high point, things were moving up. And that became pretty obvious with that as we zoom out. See, the 200 is still sloping up, where we know right now it's moving sideways, but it had been moving up. And zoom out again, we can see over here that yes, before it was in a fairly strong trend. Another kind of example I like to use to highlight this, kind of helps us kind of get rid of the noise, is we're looking at, here's a 2-year chart on the S&P 500. And I'm just going to remove some of these other indicators. We're left with just the 20, the 50, and the 200. And you can visually see where price is in the form of the candles. Well, let's come here and let's actually remove these candles. Now, based on this, if you hadn't already kind of cheated, so to speak, and looked at price beforehand, what assumptions could you make about price based on this? So we see right here, the 20 sloping upward. And we see it bottomed out here, sloped up, the 50 sloped up sooner. Likely price was going down, and this is about where it kind of started to recover. It recovered a little, probably more over here, but it took a little bit of time for the 20 to react and then the 50 to react. But take a look at the 200. It's still downward sloping, and it's finally upward sloping. And we can see up, down, up, down, up, down. Kind of in that shorter term, but intermediate turn, up, down, and then up and down. And then longer term, just down and then up. And so what this is kind of illustrating is that these moving averages can help you not miss the forest for the trees, to not get so focused on those little data points going up. Which way is trend going? And again, right here, we see short term right here. Short term is down. Intermediate term is up. Long term is down. And now we hit this point over here. Excuse me.
Bless you.
Hit this point over here. Now all three are sloping down. And then short term is up, and then intermediate term is up. And we can see, and we can make inferences on what happened to price. And again, I'm being pretty careful. I'm using past tense here because these indicators, they're looking at past price data. They're not predicting what will happen to price. Now, that said, look how long it took for this 200-day to adjust. So we see based on shorter term, recovered, dumped. And then really right about in here, probably right about in here, is where price bottomed out. And I'm saying, left because this is kind of reactive. So we probably bottomed out over here. But look, it took a little bit of time for the 200 to bottom out and recover. And we can assume this is going to likely keep going up until, it doesn't, and so to speak. And we're going to see plenty of signals of changes. Likely we're going to see, this gets into moving average crossovers, we're going to see these cross down below. That's another way indicators can be used, moving average crossovers and such. Now let me go ahead and add back on here the candlesticks. And we can say it wasn't too far off on where I circled, because it comes back to what these indicators are showing. Now, I mentioned about the positive and negative sloping, but some other signals I want to clarify is that when price crosses above a moving average, that's a buy signal. When price crosses below the moving average, that's a sell signal. So with this, we have two big signals here. One, let's kind of highlight this right here. And let me kind of clear up some of this noise right here. So I'm going to just create a brand new chart. We'll add SPY, 2 years. I'm going to come up here to indicators, and we'll do SMA for simple moving average. And I'm going to make this a 50 period moving average. So not only am I going to make this a 50 period moving average, but I'm going to also clear up some of the noise of pricing on here. And I'm going to make this line just a little bit thicker so we can see it a little bit easier. I'm going to clear up some of the noise of pricing. I'm going to do that by I'm going to come into settings, and I'm going to change the chart type from candlestick to line. Now, again, using a 50 is going to be more intermediate versus short term. And so a couple different signals we have over here. Really have two sets of signals here. One, price crosses above. It's a buy signal, back below, sell signal above, buy, back below, sell, so to speak. But positive sloping, negative sloping to positive sloping. That's another signal. So we kind of have two different signals right here. One, slope is changing, and two, price being above it. See, price below, sell, above, buy, so to speak. We see we have little interactions where it kind of bounces off of it, so to speak. Now, if I were also to add on to here, a 20 period, we see we're getting more interaction with this. Price is crossing the 20 period a lot more than the 50. You're going to get more signals, but you're going to get more potential whipsaws with this. So it's kind of what this is all addressing. And then traders, they might use, some sort of moving average crossover system as well. And this kind of goes back to, with something like this, we talk about confirmation. Do you trade when price crosses the moving average? Like if it's intraday, does there need to be a close beyond the moving average? And this line chart is simply close to close to close information. Or maybe, let's make this a 5 period. And what you do is you do a moving average, faster crossing with slower. A 5 crossing. And now over here, this barely came up, you would have bought and then sold. And it kind of smooths things out. Maybe, the 20 period like this smooths things out a little bit more. So now here, as opposed to getting whipsawed in, out, in, out, in, it's in and then out, and then in and then out, so to speak, like this. Now, another example I do really like to use when it comes to moving average crossover systems is I like to go back and take a look at the COVID drop. And I think this is a great example of kind of the trade-off between relevance and reliability. Let me actually zoom back out again. And we're going to zoom in from twice. We're going to look at this. And we can see over here on the left, price kind of crosses the 20 and then the 50 and kind of back up above, but it's a lot more interactions with the 20 than the 50, but it kind of stays up above the 200 over here. And then let's actually take a look at the drop. So if you're trading simply based on price crossing the moving average, well, I mentioned some of those earlier whipsaws where it was below the 20, above the 20, below the 20, above the 20, below the 50, above the 50. You might have gotten out over here and then back in and then out again and then back in. And then here, you would have gotten out and you would have stayed out. That's if you're just using the 20 or then the 50. But if you're using the 200, this really would have been where you would have gotten out. So a little bit more delayed. This kind of gets into that trade-off again with relevance versus reliability. Like we were then showing over here. It's more reliable price crossed the 200-day moving average. A little bit less relevant because it had to drop even further before it happened, but a little more reliable. Same thing with these moving average crossovers. 20 finally crosses below the 50. It's more reliable. Back up above the 50 versus back and forth, back and forth. And then it doesn't happen again until over here. So a moving average crossover system is more reliable than just price crossing. You get even fewer whipsaws. We see again, that's where this happened right here. Now, one thing I do want to address, want to talk about is something you'll commonly hear about, on the talking heads and media is something called a golden cross or a death cross. Now, what a golden cross is or a death cross is it's the 50 period, the 50-day moving average crossing the 200-day moving average, like we have right here. This is a death cross. The 50 crosses below 200, and the golden cross is the 50 crossing above the 200. So let's say you wanted to use this particular signal. Well, look when this finally happened. We can see the market had effectively already bottomed out. It kind of started to recover by the time this happened. This is a very reliable signal, so to speak. But how relevant is this? You waited for this to happen the worst was already over, so to speak, by the time this happened. What about when it crossed back up above? It's happened way over here. Well, by the time it crossed back up above, it's very clearly bounced. But if you got out down here and up over here, you kind of missed out on a lot there. So it's reliable, not really very relevant on here. And then going back to price crossing the 20, it's a lot more relevant, but less reliable. And so, maybe you'd said something like, well, price crossing the 50, gotten out, gotten back in right about here, so to speak. Or even the 200 out right here, back in about the same price level. As we zoom back out during this time frame, we can see when you would have gotten out and kind of those differences with this. And so I think this provides a really good example of that trade-off between relevance and reliability. And if you're a trend trader, like we're talking about beforehand, when we're really identifying trend, your goal isn't to buy at the very bottom and sell at the very top. Your goal is to capture the middle portion of the trend. If we'd simply looked at price cross to 200, we would have gotten out here. We would have gotten back in here, effectively at the same level, and we would have exited probably over here. What this means is you would have enjoyed these gains right here, and from that downside, you would have avoided this drop right here. Now, you wouldn't have bought down here, but you would have avoided this drop. Of course, the flip side of avoiding that drop is this upside over here. You'd have given up some of this upside over here like that. But you would have caught the middle meat of the move and potentially reduced portfolio volatility following a lot of these signals. Now, that's just simple moving average crossovers with that. There's also exponential moving averages. Kind of like what Peter was talking about before, and even kind of the review, what exponential moving averages do is they're just a little bit of a different spin rather than taking the last 20 periods, 50 periods, 200 periods, adding them together, and each period is equal. Well, kind of the issue with this can be these over here kind of matter a lot less than what's happening right now. And such, and so exponential moving averages seek to try and offset that by more heavily weighting more recent data. As such, they tend to react a little bit quicker to more recent data. With that trade-off that you'll get some signals a little bit sooner, but you might potentially have more whipsaws with that. Now, I remember reading a study at one point in time, and this kind of goes back to a gentleman named Charles Kirkpatrick that kind of helped put these slides together for us, that kind of looking at the differences, which one is better? Simple exponential. That while each has their pro and con, as far as signal generations go, one wasn't really statistically better than the other on that. So it kind of comes back to like, well, which one should I use? Well, really what becomes more important is which one are you more familiar with? Which one are you more comfortable with? Which one do you understand better? That's the one that you should use, because one isn't inherently better than the other, so to speak, with that. Now, Peter, I know I've been kind of talking for quite a bit of time on simple moving averages, moving average crossover systems, exponential moving averages. A lot of that same thing applies, like I was talking about. But anything you might want to dig a little bit further into when it comes to moving averages?
I think in the interest of time, we'll probably move on to the second of the 4 or 5 indicator types we were looking to get into. I think what I would say is the moving average crossovers. That's really the thought process or purpose behind the MACD. That's the moving average crossover, or excuse me, convergence divergence, which talks about the relation of different exponential moving averages, one with a faster calculation, one with a little bit longer of a calculation, and how those interact with each other. And if you can utilize that type of indicator itself, that might then also shed light on how those moving averages are interacting with each other, not just necessarily from the price over or below a moving average itself, but also the relationship between moving averages, like Nick was showing when he had kind of taken the candlesticks off of the chart and really just looked at the moving average relationships themselves. But at least hitting on a couple of these momentum indicators, I'll try to make quick work of this because this hour is flying by here, folks. When we talk about momentum indicators, we've already thought about trend as that gauge. That's what the moving averages can help us with. Momentum indicators are there to try to help us maybe visualize or conceptualize, okay, how much of a kind of momentum is behind a move. Now, there's a few caveats here, some different things I want to talk about, but I want to start with this last bullet point first. It says they don't work when a trend is strong, but excel in trading range markets. And we'll speak a little bit to that. But what I think this is really trying to shed light on is that over towards the left-hand side, the thought process behind these type of oscillators, as they're called, is that they are bounded indicators more times than not, or different oscillators, where they can only go so high or only go so low, oftentimes based off the calculation behind the indicator itself. So when an oscillator reaches a zone, well, it's thought to be overbought if it's at the higher end of that zone. When it reaches the lower bound, it's thought to be oversold. This next bullet point is crucial, though, and it's one that you certainly want to read hand in hand with these first couple. That oscillator value in these zones indicates that the market is vulnerable to a reversal. Doesn't mean that it's imminent, easy for me to say. Vulnerable is the key there, but the signal often occurs if and when that oscillator exits one of these zones. I think when many clients learn about these types, they say, okay, well, I mean, it makes sense. Overbought. It's overbought. Okay, I guess that means I'm late. I gotta get out, or I can't chase it here and now. Oftentimes, especially if there is a large underlying trend, which is what this bullet point is speaking to, if it's overbought, more times than not, it's that way for a reason. The general crowd is kind of chomping at the bit to buy on any minor pullback and actually push it higher, keeping it in that overbought zone. Same thing if it's oversold. Sellers are fine to take incrementally a few bucks more on any type of minor pop higher in the grand scheme of things as it's trending lower, which is why we're looking more of the exit out of an overbought or exit out of an oversold zone or region for more of those opportunities. That's what this begins to talk to, especially when a new trend is beginning. They can reach these extreme levels and stay in these extreme levels for quite some time. I'll point towards that as we get to a couple of these indicators, but once again, with only 15 minutes left, I really want to get a move on here. I'm going to try to cover the stochastic oscillator and some of its characteristics and examples, as well as RSI, compare and contrast very so briefly. A stochastic oscillator, for lack of a better term, has these overbought, oversold regions, oftentimes at 80, down at 20. As we had talked about, crossover signal occurs when these two lines are in that overbought or oversold region and begin to exit out of it. Now, why am I saying two lines? Well, it's because there's going to be the actual stochastic line itself, known as percent %K, and then there's going to be a bit of a moving average of that line, the percent %D line as well. And that's what we're going to notice on this second slide. I'm going to demo this as well. Other types of signals that we get are the classic divergence. Divergence, just a fancy way to say price action generally moving higher with an upward slope here, but the indicator not reflecting that as well. It's actually diverging or in the opposite direction. You can have bearish divergence, you can have bullish divergence where maybe price is heading lower, but the indicator is actually heading higher, more like what we see over on this side. So the kind of whipsaw up above, the percent %K line up above its percent %D, as well as coming from an oversold up to overbought might be a signal in and of itself. From overbought down out of that zone could be a signal as well as these divergences. Some of this is going to be very, very similar with relative strength. I'm going to speak about this in just a moment, but let me hop over to Active Trader Pro and really tell you, for lack of a better term, what we're doing is we're looking at a window, and this is in its calculation how it differs from relative strength index. Now, if we're backing this out, let's say to 1 year, down below, I have added the fast stochastic. You can see this ranging higher, down, lower, lower, up, higher. And those are the two lines I was referring to, percent %K and percent %D. Now, this percent %K is a 14 period. Okay. Stay with me here on this and let me shed light on what that means. What that means is this indicator has a look back window, and that's what I've drawn here, 14 trading days worth of information in this window. What it then is going to do is look at what was the absolute low point on this candle wick. Looks like the low was down at about 135 and 12 cents, but roughly speaking, way down here in our window. Where was the absolute high? This is on this candlestick here, just yesterday. Now that we have known factors as to our absolute high, our absolute low over this window, where is price action right now? Kind of on that percentage or percentile basis, which is how we are then going to come with our calculation. So what this is telling us very simply is, where is price action right now in relation to its window? And what we'd see and what we'd observe is that it's practically towards the very, very high side of that period in time. Now, of course, as you can imagine, this is going to be for traders that are really, really concerned with what's happened recently. Where do we stand here and now? That is what is extremely important to me. What that is then going to do, given the calculation for this, is have the ability to go from a high end of that range to a low end of the range pretty quickly. And that's just because it's just based off of that time period or window. For instance, if we were to look here at this 14 days, well, it's a bit more compressed, of course. Where are we from the high? Where are we to the low points? It's even kind of out of the frame of my window, but I think you all get the point. And what we would observe is, well, we went from a point in time where this stochastic was giving us a high reading, saying, gosh, we're up here, we're in the 90s or so in this trading range. We're pretty darn high. And then very, very quickly, next 14 days, and it's actually swinging down lower. Now what we're observing is that we are towards the lower end of that range, the 5, the 6 percentile or so of just this trading range, trading window. And that is why with the stochastic, these signals kind of excelling in these trading ranges, saying, okay, well, we had been higher, but if it starts to dip, maybe that trend or range is now going back and pinging towards the lower end of that recent trading range and then moving back up higher as well. Now that's going to differentiate from RSI, which I'll circle back to in just a moment. RSI is going to be a little bit different given its calculation, going back to how it works, given that it's an oscillator. It's going to share many of these very same characteristics. What the thought process behind it? We're trying to measure the speed and change of these price movements overall. RSI, once again, bounded from 0 up to 100. Generally accepted overbought, oversold at 70 and 30. but you certainly want to be mindful of these additional zones as well. And that goes back to kind of a thought process as to moving the goalposts if there is a strong trend present, either in an uptrend or a downtrend. Now, 70 to 30, maybe your common overbought, oversold. The ranges as well at 50 in the midline is also very important. But the thought process is in an uptrend, if we're thinking it's going to be overbought, well, overbought might not be 70. Maybe overbought zone now is going to shift up higher. Maybe something like the low end of the range at 40 rather than 30. Maybe the high end of the range like 80 or 90 rather than 70. Maybe that 40 to 50 acting as the support. And the flip side of that in a strong downtrend, perhaps on the high side, it's only getting up to 50 or 60, but maybe as low as something like a 10 or 20 rather than this 30 point. Once again, that is for strong uptrends, downtrends. When it comes to divergences, when it comes to our signals from the oversold region up and through, or from overbought down and through, those are going to be the classic thought processes. Here we've got kind of this bullish divergence, price action heading lower. However, our signal is beginning to get more positive. Doesn't necessarily mean it has to go higher, is just showing us that from the recent trend and this recent price action and that recent momentum, well, it was extremely accelerated towards the downside. Maybe that acceleration is at least slowing. Doesn't necessarily mean that it can't ramp back up, doesn't necessarily mean that it is over, but it's slowing, which is really what that gauge of momentum is there to try to tell us to do. So let's take a look here on the chart itself, and then I'll probably kick it back over to you, Nick, to cover some of these volatility or volume indicators. If we are looking at RSI based off that same 14 period, well, similar thought process. However, it is not, as we can tell, even with that simple calculation, based off of the same methodology that the stochastic is. It does have its ability to move higher and lower, but it's a bit more muted. And I'll show that when I compare the two. However, we had talked about those zones where we were in a trading range and then price action broke out, didn't we? We talked about, well, if something has maybe been in a range for some time, almost like what we are seeing here, well, it can kind of remain in that zone for a bit. But then when it actually shows a new trend and heads higher, if you were under the approach that, well, it's overbought, I guess the move is done. In this case scenario, the move nearly just began and it stays in this overbought 87, 85, 86-ish range for a period of time. And then as it begins to decelerate, kind of gets back into this trading range that we had identified in our homework up here as well. So as we come from this overbought down through the kind of middle portion of the region, does it mean that price came collapsing down? No, not necessarily, not really at all. But what it does tell us is that the kind of oomph, for lack of a better technical term, behind this move higher is now beginning to maybe wane. Perhaps there is less enthusiasm behind this move until, as we see here, it begins to actually get back up into that overbought region, which is kind of where we are now. Let me cycle over to a stochastic versus RSI. I think if you were to squint at these two, they have some generally very similar or adjacent characteristics, at least as far as their trajectory. You can see when it's higher, it is higher. When it starts to come down, the stochastic, since it's more reactive to what's happening most recently, is going to be more prone to that up and down very, very sharply from the high to the low end of the range. Whereas given its calculation RSI, although coming from a overbought into the kind of middle of the zone, middle of the range, it doesn't really traverse all the way from that 80 or 70 down to 30 like we had seen with stochastic. So there's just a different variation in calculation behind similar concept. Momentum. It just depends on what it is that's really most important to you. Is it the price where we stand here and now? That would be maybe the stochastic. And if it's kind of a culmination of what price action or momentum has been over a period of time, that's a little bit slower moving, maybe that's going to be RSI. The last thing I would say, Nick, is this is just the fast stochastic. There also is a variation or version of this, which is known as the slow stochastic, which would have a little bit more of a shape or trajectory, potentially that RSI does. But having that said, Nick, you go ahead and take the screen, give your 2 cents on any momentum indicators, or if you want to cover or tackle maybe a volume or volatility indicator, feel free to go to it.
A couple quick points I want to make is, visually looking at these, fast stochastics or slow stochastics really. I see you actually have stochastics fast versus RSI. We see how similar they are. They're both up at the same time. They're both down at the same time. Peaks and troughs about the same things, and so it's not really beneficial to have them both on the chart. And if we were to add on like Williams percent R, slow stochastics on this, we can see that we're starting to get a lot of duplication because it's all based on price or price and volume if they start to incorporate volume with that. And so it's just kind of want to stress that, again, you just want to pick one. You want to pick one, you want to learn about the one, you want to become familiar with the one, and you want to understand the signals that's giving you because they're really all kind of showing the similar things, and it's not beneficial to have more than one on your chart. That was one thing I wanted to mention. The other thing I wanted to address was, again, just being overbought or just being oversold, again, isn't that reason to get out. Because security can stay overbought or oversold for a long period of time. Always kind of equate, trend to be your speed. If you're in a car, how fast are you going? Momentum is, are you accelerating or are you decelerating? Now, when you turn on the access road to get on the highway, you just tap the accelerator and let it off and then keep going at 20 miles an hour? No, you accelerate from 20 to 30 to 50 to 70 to get up to speed. You're could be accelerating for quite a bit of time to get up to speed before you let off. Likewise, when you're wanting to exit, you just tap the brakes and then you're magically going 5 miles an hour. No, you got to slow down, kind of turn off, exit, and kind of make the turn. So it's a little bit of a process with that. And so, again, it's more about when you are leaving the overbought or oversold areas that's important versus entering. And a lot of those oscillators work the same way. Something else that you want to bring up a couple examples on is, again, the divergence. And this to me is really where these signals are a lot more useful, is the divergence. And you can also get momentum divergence as well with this. And so here we have a positive divergence. Momentum's making higher lows while price is making lower highs. And what you want to check for is, okay, just because it's doing this, we see higher low on here. You wouldn't buy it here because we then have it again. Well, you'd want to then look for confirmation with your trend indicators. And one of those confirmations could have been, see price cross back up above the 50 period and the 200 period over here. That could have been confirmation that things are changing. But still got to be really careful about that because look what then happened. It did break up above it, but then back down below, and now we have a lower low and a lower low and a lower low and such. And so just because you see this divergence doesn't mean that trend is going to turn around, but it could be, again, that signal to be mindful of, to be aware of. Now, I want to kind of pull back to another example. And there's quite a few examples with the broader market, but this is a more recent one. This is negative divergence. Again, these lower highs with momentum here, while price is making these higher highs. And yes, this started right in here, but if you went, oh, we have divergence right here, let's get out, and you exited in the middle right over here, well, what might have happened? You might have gotten out at 5,000 and missed the ride up to 5,300. That's another 6% up that the market went from there. And so this comes back to keeping your eye on the other indicators, looking at trend. And so you might have then, again, seeing this divergence gone, okay, and maybe I get out of some of my position when price finally drops below the 20 moving average, or really the 50-day. Might have gotten out right there. But then starting to have slightly higher momentum, but again, with more higher highs on here. And so really what traders are going to want to see, want to make sure the market stays up here, that it doesn't start to exhibit those downward trend signals. And they'd really like it to see momentum come back into this overbought territory to start to have higher relative highs, so to speak. So we're not getting lower highs, lower highs, lower highs with momentum. Now that's, again, that's momentum. I do want to add on, want to talk about some volume indicators. And this is going to be just real quick with this, because as we talked about, a lot of traders don't really look at volume indicators that much anymore. Where volume indicators come into play is, again, also looking for those divergences. Is price trending up, but the volume indicator is trending down, or vice versa? That becomes important. And let me shift over here from SPX to SPY, which actually has an underlying security it could be trading at. And we're getting some of those divergences. That's what traders want to look at, what they want to pay attention to. What on balance volume does is, if it's an up day, it adds volume, that day's volume to it. If it's a down day, it subtracts it. And if you start to have more, if it's the same number of up days as down days, but there's more volume on the down days, that can be a potential bearish signal, and vice versa. And so, again, there is just one signal. It's not just momentum, just volume, just trend. It's it's a combination of these signals. You're looking for confirmation with each other with these particular signals. So that kind of covers, wraps up some last things I want to mention on momentum, kind of addresses volume as well. One last thing I kind of want to touch on to wrap us up is volatility indicators. And one of the ones we have on your course are Bollinger Bands. That's a volatility indicator. One of the ways that these are utilized is when you see the band start to kind of get wider versus contract. We see they kind of start to compress, and then price breaks out. They get wider. And then kind of compress, price breaks out, and they get wider. And it could be an upward breakout like right here. It could be a downward breakout over here. And we see it even broke out downward and then recovered and come back up. So traders will use this to see, well, are we getting kind of like a compression, to then look for the potential explosive movement. It could be up or down on this explosive movement. And one last kind of volatility related indicator I want to mention, I want to talk about average true range, ATR. And we'll do it as a percent versus the rough. What average true range is showing us is, on average, how much a security moves throughout the day. And one of the times we really talk about this is, as it relates to stop orders. If the security moves on average $1 a day, and you set a stop order 50 cents down, well, likely you're going to get stopped out in a given day. Or if it on average moves 25 cents and you set it 50 cents down, one might have to either have a really big day downward or string multiple days in a row with that. Also, we can see over here, see average true range kind of increased where it had been lower, and then boom, it popped up. We're also seeing this with Bollinger Bands. The bands get tighter, and then they get wider right here. We also see average true range got higher, reflecting similar information is what this is kind of addressing. Now, what average true range is based on is a little bit more different than Bollinger Bands. Bollinger Bands, and if you're looking at historic volatility, that's going to be a lot more similar. If you're looking at Bollinger Band width versus historic volatility, because Bollinger Bands are you're drawing, standard deviations above or below with that. That said, Peter, I know we're really just past time. I think that's a kind of wraps us up with the last type of indicators that we wanted to discuss today. As we mentioned, kind of like drinking water from a fire hose. There's so much that we could talk about today. Anything else that you might want to kind of wrap us up with?
I think just maybe going back to a couple tools and resources for your folks. And I think that goes back to what Nick just said, is that there is no shortage of indicators, or there are no shortage of indicators. Want to make sure I'm grammatically correct. Been a long week, ready for this weekend. But point being, if you are in Active Trader Pro, which is where we had done the majority of our demonstration today, and you are interested in learning about different indicators, one avenue under the Help menu and Learning Center is the Technical Indicator Guide. Once again, Help menu in the top right, Learning Center Technical Indicator Guide, among other useful resources, would allow you to go ahead and break different indicators alphabetically. You can also search just by, let's say, momentum. Maybe you wanted to go ahead and go back to momentum indicators, or maybe we didn't go over as many volume or volatility indicators as you want. You can break these down by different groupings as well. Beauty here is, well, maybe you're interested in that average true range percent Nick was talking about, but want a little bit more info. If you come to the indicator guide, just as a pure example, setup is going to be very, very similar. They're going to have a description here towards the top and kind of about what it is. They're going to talk about how the indicator typically works given its calculation, and then the actual calculation down below as well. So that's a very just quick and easy way to see. And they'll also oftentimes, like Nick had said, well, this is in percentage terms, which I like, relative terms, rather than average true range, which is in those nominal or dollar terms. Reason that could be important is average true range is a nominal price point. And well, maybe that made some sense to you if the stock was trading at $50. What if all of a sudden that average true range is going to be vastly different if the stock price has doubled or tripled? Maybe that stock that was up at 50 now has an average true range that could look misleading if it's much, much larger in price on a nominal basis, which is why expressing it in percentage terms to keep it on that relative basis is something that I'm a proponent of as well. Last thing I would say on that is not just limited to Active Trader Pro, really through Fidelity's website and Chart Plus. As I had said, there's probably a new indicator that was created today, Nick, for all I know. If not one, maybe two, three, four, who knows, in this day and age with computing power. There are actually more indicators on Fidelity Chart Plus than currently housed on Active Trader Pro. You can go through the indicator library. Once again, it's similarly laid out at kind of A to Z alphabetically. You can search for something, or there are these categories off towards the left-hand side. Like we had said, volatility, volume, momentum, oscillators, like we had talked about, and then being able to actually go through these. If there is something that you are looking to learn more about, averages. Hey, he was talking about simple moving averages. Let's look into them a little bit more. There's this icon off towards the right. It's going to go ahead and give you a quick paragraph or two on that indicator. And I'd certainly encourage that for anyone. Nick, you hit it on the head. What are the best indicators is often what we get used on. It's the ones that help you make decisions. And it's the one that helps you manage your risks while looking for opportunities. And I think above and beyond just kind of a tongue-in-cheek answer, I think it's some type of combination of being able to package together some type of analysis of trend. That's a great place to
Mm-hmm.
start. Are we in an uptrend? Are we in a downtrend? Are we range bound and there's really a lack of trend? Then being able to say, okay, if there is a trend, how much momentum is behind it? How much
Yeah.
volatility is maybe behind that trend? Is it slow and steady just every single day, packing on a percent or two? Or is it up 10% one day, down 5% the next, up 10% the next day, down 5% the next? both of those charts might look similar in their trajectory, but maybe one has too much volatility than you want to stand. And then lastly, is there maybe some volume behind a price move that you have seen, or that momentum and volume volatility altogether? So I think a combination of indicators, not just five momentum indicators, not just five trend or five volatility indicators, but maybe one from kind of each grouping or bucket, so to speak, could lead towards not always a perfect solution, but maybe a little bit of a different puzzle piece that hopefully gives you a little bit clearer thought process as to what your trade thesis is, and then also what could invalidate that thesis. Because many of these indicators, once again, going back to that homework, are about reacting to what we're seeing, not predicting what we want to have happen. I'll leave it at that, Nick. I know we're 10 minutes past. If you've got one last word, go for it. I've got a meeting, so I actually have to step out here.
One interesting question that came in that I want to touch on as we wrap is we're asked about leveraged products. And bluntly, you have to be mindful of the way that those leveraged products work. And I say that because I want to bring up that, let's say something is just tracking the market. And well, the market goes up 10%, it goes down 10%. And you might say, well, that's not going to happen. But I can point to a day where I remember coming in on Monday, March of 2020, the market dropped 12%, and Tuesday the market was up 10%. The broader market actually happened. Now, if you're 3 times leveraged, the market goes up 10%, your product goes up 30%, and then resets. And the market goes back down to break even, your product then drops 30%. Well, 30% of 130, it went from 100 to 130. Well, 30% down is actually 39. And it drops to 91. And the same math works if it goes down 10% and then back up 10%. Well, 30% of 100 is 30, it drops to 70. Well, now 30% of 70 is 21, it goes up to 91. And so you have this weird thing that happens with leveraged securities that's a little bit different than the broader market. And so you have to keep that into consideration. When you start to look at things that trade based on volatility or the VIX index, that gets even weirder. You can't really use technical analysis on like the VIX index, because VIX isn't really going to go down to 2 or 1. And a lot of people thought that it wasn't possible for it to drop below 10. It actually went down to 8-ish. VIX also isn't going to go up and up and up and stay at 200 forever. Like a stock can go up and do that. So technical analysis doesn't really work on that. Now, that said, if you were looking to trade a leveraged ETF, like leverage to the S&P 500 or inverse the S&P 500, what an astute technician would do is they would perform their technical analysis on the broader market, on SPX. And then if they liked it, they wanted to be long the broader market, well, then they might implement their trade through a leveraged product, if it makes sense. And then if things switch and they want to no longer be long the broader market, well, they might then exit their trade. Or if they want to be short the broader market based on their trend analysis or something, they might then look for an inverse. And so as opposed to trying to do technical analysis on the chart of a leveraged product, they might perform that analysis directly on the index that it's trying to be a leverage of. That way it takes out some of that other wiggle stuff that happens based on the leverage, based on the reset and such. It makes things a little bit cleaner. And it's the same thing we talk about for options traders that look to trade options on those leveraged products. Well, as opposed to trading options on a leveraged product, we'll simply trade a different amount on the non-leveraged product. You then don't have the situation where you're trying to back up multiple trailers, so to speak, at the same time. With that, though, again, thank you for joining us, everyone. Hopefully, this has been a good, valuable use of your time. We definitely look forward to seeing you back with us next week. We're going to be talking about charting patterns and pattern analysis and such. It's should be a great class. Take care, everyone. See you back next week.